So I like to just think of the IRS tax code as a playbook of incentivizing behavior. It's not really meant to make us pay more taxes. It's meant to have opportunities of how we can use the tax codes to influence other behaviors. So roll up to, this is now 2015, 2016, when these guys have this conversation. One of them says, so the problem is not the code, the problem is the process and how to calculate. Do I hear you correctly? That's when they dialed into the processes that they use today that have now helped over 7,000 clients and about 15 million acres. When we put this tool in their hand, and at the end of, when they're in Q4 tax planning, they can go buy another piece of dirt and they can truly build their balance sheet by investing in more land. And oftentimes will shift their mindset from, instead of leasing land everywhere, this gives me an opportunity to buy it. Now I get the tax deduction with it. My cost basis is less, and we're building their balance sheet.
Welcome to the Landowner Insider, the podcast for Texas landowners who want to stay up to date with current events shaping our state. Here we talk about issues that actually impact your Texas lands, markets, water, wildlife, policy, and the decisions that are shaping our state. I'm your host, Kasey Mock with the Mock Ranches Group. And in each episode, we sit down with the people who are shaping the future of Texas. We're not afraid to ask the hard questions. This is the Landowner Insider podcast presented by the Mock Ranches Group.
Some of these require disclaimers up front. This is probably one of them. I'm with Kyla Dodson of Boa Safra Ag. This will be super informative for me, but also the listeners as we talk about the legacy soil tax nutrient deduction, Section 180. But one thing we're not doing is what, Kyla?
We're not giving tax advice.
Yeah, we're not giving tax advice. We're not giving legal advice. We're not giving investing advice, right?
Correct.
We're just discussing this so that we all have a little better base of knowledge about this section of the tax code. So I appreciate you coming. We've been friends for quite a long time, and I appreciate you coming in to talk to us about this. Boa Safra is a company that I first heard about maybe 2 years ago. Mm-hmm. So tell us what Boa Safra does. 30,000 foot view, and then we'll dig in.
Yeah, absolutely. Thanks again for having me today.
You bet.
Kasey, you've built such a great program, and I love all the extras that you do as a professional in our industry and as a leader. So thanks for having me and to discuss this tax strategy with our landowners and with other brokers and agents, because truly we become land optimization specialist in these areas. So
it's hard to afford it, right? The land's hard to afford. So
yes.
if there's some real money that a landowner can make up, mm-hmm. I think as a fiduciary, that's our job to educate them on that.
Yes, sir.
Just as much as it is to educate them on cow-calf operation or ecotourism or hunting operations, it's also our job to introduce them to people that can introduce them to another bucket of money. Say, here's another potential bucket of money that helps you hold on to that piece of ground or recoup some investment.
Right. Save on your taxes and reinvest that in the way that you want to use those dollars.
Yeah.
So it's a very great opportunity. And like you, about 2 years ago, we started discussing this, and it was what we hear often is, this is too good to be true. Why don't I know about this? Why hasn't my CPA brought this to me? Why hasn't my wealth planners and even my tax attorneys? And the answer is they didn't know either.
Yeah.
And so it's still fairly new, not yet industry standard. I think in the next few years, this will become industry standard. And the reason that I work with Boa Safra, and you as well would affiliate there, is because they've been at this for 10 years. So 3 farmers all have the same CPA, they're neighbors, and their CPA is retiring. The old guy sends a new kid to take his place. The young guy shows up during planting season. So of course, tensions might have been a little bit high, and it starts talking about this legacy nutrient deduction and would they be interested in using that. So these guys all call each other and they're confused. They're like, why didn't the old guy ever do this for us? Now this new kid shows up. Does he even know anything? What a wild idea. And if it's real, why wouldn't we have known and taken advantage of this?
Yeah.
So as they brought them together at lunch and the old guy told the story, that the tax code's actually been on the IRS book.
The section of the tax code,
since 1960.
Oh, wow.
And it was a result of all of the government entities were challenged with how to stimulate agriculture after the Dust Bowl. So the optimal theory behind this is if you were a good steward of your land, you didn't overgraze it or you didn't overgrow your crops without properly replenishing the nutrients of the soil, then you should actually be creating an excess in nutrients going forward. And if you're a good steward of the land, then you should have a reward. So I like to just think of the IRS tax code as a playbook of incentivizing behavior. It's not really meant to make us pay more taxes. It's meant to have opportunities of how we can use the tax codes to influence other behaviors.
Yeah, most people spend their time learning how to pay taxes. Mm-hmm. That's less than 10% of the tax code. Mm-hmm. The other 90% is how not to pay them.
That's exactly right.
But the government wants to partner in those. It's not like you're trying to cheat the government or there's this ultimate life hack that you've discovered that is a workaround. It's just understanding the tax code and where the government wants to partner with you, where the government wants to reward you for certain behaviors. And in this case, what maybe somebody's invested in that they need to recoup some of, right?
Absolutely.
Yeah.
You're exactly right. So truly that incentivized behavior then is to be a good steward of your land and that there would be excess nutrients available after you used it in agricultural production to either raise livestock or grow crops. That's simple. So these, back to my buddies, Tyler, Bryce, and Zach, then they sit down with the two accountants and find out the story. It started in 1960, but there was not any guideline on how to use this tax code, how to measure the values, what would be allowed as a deduction until 1995, which is pretty much the lifetime of a CPA's career, right? 30 to 40 years in that chair. And then they're passing it on to somebody else. So the old guy says, we didn't have this until 1995, and then we still didn't have very good information on how to utilize it, what's going to be audited. So they had this cowboy era that where people were taking soil samples at different depths. They were using different measures of values. And so the numbers were all over the place. And it was an audit risk. Mm-hmm. And there wasn't a consistent basis of how do we value this legacy nutrient deduction. So roll up to this is now 2015, 2016 when these guys have this conversation. And one of them says, so the problem is not the code, the problem is the process and how to calculate. Do I hear you correctly? So that's when they dialed into the processes that they use today that have now helped over 7,000 clients and about 15 million acres. So over the last 10 years, they've used very rigorous science and data and the economic analysis to now produce the product that they have today. And the test of that is, one of the questions we get a lot is, okay, if I use this, am I putting myself at audit risk?
Yeah.
Very fair question. Out of right at 7,000 cases, they've had 8 audits. Of those audits, 4 of them were on cropland, row crops, 4 of them were on pasture land. Of those 8 audits, the smallest one was about $200,000 and the largest one was $42 million.
Oh.
So that will get your attention to make sure that your processes
pretty wide range though.
Are tight, wide range. So in that, the results though of all 8 of those have been a no change ruling as it has to do with their work, the work product of the data that was provided, the analysis that was provided, economic and agronomic, and then the reporting that is very strictly following to support the IRS tax code.
Got it.
So now your tax professionals, once they get this report, have not only the confidence in the number that's been calculated, which we are on average $1,700 an acre across the United States. That's row crop and pasture land. So $1,700 an acre is the number we use as just our average of expected results when we do a little desk evaluation. The cost for that is $40 an acre. And that's going to send out the test crews. Mm-hmm. They take soil samples every 10 acres. They actually build their samplers are little spectrometers, so they're really cool. And they build the map every time they take a soil sample. They're time, date, and geo-stamped. So it truly does build the map of where they take each one of those samples to provide a broad spectrum across the land that we're looking at. Then they do the agronomic evaluation of macro and micronutrients. That's another thing that has not been really specified by the IRS is what all nutrients do you need to measure. So we use more than most other companies that are doing this.
Okay.
We're also take all of our samples at a very specific depth so that it is consistent across the board as well. So then we produce this report and we support the tax professionals that will be preparing your tax returns and actually applying that to your own personal tax situation. We'll support them through how to use all the forms, which line to put it in, all the questions that they ask. And then even in the case of if they were audited, then we'll provide that support during the data collection. And of those 8 audits that we've supported, there has not been any of those go past just providing information or explaining what was used. But we also gathered a lot of data then on what do auditors ask. Mm-hmm. The number one thing we have to do is prove that it is in agricultural production. You're producing some sort of crop or a meat product.
Yeah.
Or a hair product even, like agricultural
food fiber
production. Yeah. Exactly.
Yeah. Protein, food
so
fiber.
We, and I know y'all rep a lot of hunting ranches too.
Sure.
That sometimes gets in a gray area. But we have a lot of our hunting ranches that do either cut hay or grow, or they run cattle during the summer. So we have to evaluate all those situations and see if it, if they primarily hunt, but they also are running cattle, then it could still possibly work for them.
Yeah, or another hoof stock, like exotics are considered hoof stock, privately owned hoof stock, that'd qualify. They qualify for ag valuation on your property taxes. And you can depreciate them, You're just like you can a cow. Okay, you've jumped ahead and said a lot.
Sorry.
No, but that's okay. I'm gonna ask a couple of questions so we can get clarified for everybody, because I'm gonna pretend that the people listening know almost nothing about what you just said.
Okay.
Because a lot of them probably don't. Who's the typical client? Is it traditional farmers? Is it high wealth individuals, absentee owners, producers? Who's the typical client for BOA SAFRA when you look at this legacy nutrient deduction? Because, let's start there. Let me ask that question first.
Yeah, very simply put, it's somebody that has income that needs tax deductions to offset.
Got it.
So if they are a tax-paying individual or entity that is looking for tax deductions to decrease their tax burden, and they have land in their agricultural production, then yes, this is somebody that works for.
Okay.
Definitely works for a lot of our high-wealth individuals. In fact, BOA now is working with 15 of the top 100 landowners in the nation, which they don't make their money farming and ranching.
No.
They make that it's entertainment. It is oil and gas. It is whatever those industries might be. And a lot of those are legacy money as well, right?
Well, a lot of people might say, a lot of people don't like that. They're going to look at this and say, well, this is another way for the rich man to save on taxes. But what you have to understand is the amount of conservation, the amount of groundwater recharge, the amount of wildlife, the amount of flora and fauna that is managed on privately held land in the United States.
Absolutely.
The best managed land in the United States is not public land. It's private land. And so the government, they know they have to incentivize landowners to do a good job of managing private lands long term. Stewardship of private lands long term, I believe, and this is actually in our mission statement. Let me read it to you. It says, I don't have one behind me, but it says stewardship of private land is directly, it says stewardship of private lands is directly connected to a healthy economy and a strong democracy. I believe that. It's written in all of our mission statements for our companies. And so the government has to incentivize people to maintain open spaces. They have to incentivize people to be good stewards of it long term. They have to incentivize people to grow food and fiber. They have to incentivize people to manage wildlife, because if not, it's not good for the greater whole of the country. It's not good for the greater populace if we have massive erosion, if we have depleted wildlife resources, if we have depleted water resources. It's not good for the greater whole if we're not independent on our food and fiber production. It's not good for the greater whole if these lands are not managed well long term. But they're very expensive to manage. This is what somebody in town doesn't understand. It's very expensive to manage large open spaces today. Employees are expensive, tractors and fuel are expensive, fertilizers are expensive. Cows are high today to sell, but they're also very high to repurchase. Being in the wildlife industry is very expensive. It's very expensive to manage wildlife, and now you're subject to state rules and regulations on how you can use those. And then you've got disease factors and drought and rainfall and commodity prices and all these things. Ranching is not a very lucrative business. Agriculture can be, but ranching itself is not a very lucrative business in and of itself. It's something that somebody has to really want to do. They're in it long term for the land, they're in it long term for the legacy or the lifestyle. And so things like this exist because the government, somebody in government, was wise enough to understand that long ago. We have to maintain open spaces in private hands for management of that. Okay. This is not a separate bucket of money, though, like NRCS. So NRCS, FSA, they've got buckets of money that are cost share programs or grants. This is not a cost share program or a grant.
No, sir.
Okay.
It is not. And I appreciate your mission statement and your insight there. And you're right. It is expensive to be a good steward of the land. And that's where the whole operative theory behind this is that you're rewarded with an opportunity to have a tax deduction associated with that. And when it goes to either a separate bucket of money, grants, even tax credits, this is not that. It is this simple. We know that we can't depreciate land, but this is a depreciation of the fertility level of your soil from the excess nutrients that are available.
That's a great way to put it. Okay, we take this office. I own this office. I can depreciate anything in this office that wears out. Okay, so the light fixtures, the flooring, the windows, the roof, the furniture. I can depreciate anything in this office that wears out. The quicker it wears out, the quicker I can depreciate it. Land, you can't depreciate. Right?
But the fertility level of your soil could change.
The fertility level of your soil, you can. Improvements that you add to it, you can. Some of your livestock, you can, including exotic livestock, you can depreciate. So, I like that.
It fits right into the playbook of how to optimize the values that are associated.
Yeah, most people understand this on the single family, multifamily, commercial real estate side of things. It's why commercial real estate investors and single family, multifamily real estate investors do what they do. Nobody gets really excited about buying that house over there across the road and managing dirty renters. Those renters across the road were really dirty. I know they're gone now, but they're very dirty. Nobody gets excited about managing those renters for $200 a month.
Correct.
But once you capture the depreciation of that house, do a cost segregation study on that house, you're saving enough money on your income taxes to make it worth it. Yeah. It's not the $200 a month. It's the long-term appreciation of the house, and it's how the government wants to partner with you for creating housing that's affordable for those dirty renters. Okay, same thing. Cows are dirty. Let's use cows as our dirty renters on the land, right? Same thing. The government says we're going to incentivize you with things like this, that you can depreciate some of the components of this piece of property, the fertility, in exchange for making space for these dirty renters that are 4-footed called cows.
And they actually do produce fertilizer, the original form of fertilizer, right? In the manure. So that is a little bit of a question we get quite a bit is on rangeland versus row crop. And because we can manage our fertilizer and we can manage what our yield production is on row crops, we usually have really good accounting for those things, our expenses, and then our income on our yield. And oftentimes on the cattle, people ask all the time, well, how do you measure the fertilizer? Well, manure. They're producing manure and they're trampling the ground and it's going back in the ground. And so we are continuing to put more nutrients back into the ground.
Right. When I hire a bow software, what actually happens? Walk me through that process. How do you evaluate it? Do you send an agronomist out? What do you do?
That's a great question. The whole process starts with, and this is something that as land brokers that you can help your clients get their information. The information we need to know is the legal entity that it's currently titled in, when you purchased it, and what you paid for it. That doesn't have to be exact, but we need to know what that cost basis is, because sometimes we may have a limitation on how much of the deduction that we can use, even if it's calculated at that average of $1,700 an acre. We may only have cost basis in there at $1,000 an acre of what you paid for it or what the value was at the time that you inherited.
Okay.
So real important that we do what I call a desk evaluation first to even make sure that this is going to make sense. The parameters that we generally use to even qualify, and yes, we think you should go forward with this, is one, was it purchased or inherited from the year 2000 forward? And we have really good databases built back to the year 2000 of our cost of basically fertilizer, all the micronutrients that we're measuring, and that you have at least $500 in basis. And then, of course, we've got to go by the acid test of, is there agricultural production on the land? So the reason I say that is that makes the economic return on the year 2000 forward and the $500 in basis is kind of our lowest point of economic return. Again, we're going to charge $40 an acre. As we go back to, the further we go back, 2010, 2005, any of those, the further we go back, the cost of land was less and the cost of fertilizer was less.
Yeah.
So that's where we may not have enough basis. But at least at that $500, what most CPAs are comfortable with is somewhere in maybe 30%, maybe 50%. We've seen some be as aggressive as 75% of depreciating the cost basis of the land, depending on your and their risk level with that. So we just land at 50% for conversation here. That if most are comfortable with up to 50% of that basis, that at least you'd still get a $250 tax deduction per acre for the cost of 40. So you've got a 6x return on your money. Does that make sense?
Yeah.
Do you follow me through that? So, but if we've got land today that's $10,000, $20,000, $30,000, $40,000 an acre, right?
Yeah.
Then if we get that, again, our number should be higher. So we might be at the $2,000 an acre average there. And that makes a lot more sense. And we're not limited by the basis.
Yeah.
So that's why we need.
Yeah, $15,000 an acre.
Yes. Perfect. So then that's why we need the title that it's in now. And if it's held by a corporation, it's got to be a tax-paying entity that owns the land. Or if it's just a partnership or an LLC that's going to roll up through a K-1 to an individual's tax return, then we can track it that way. So we've got to know what kind of income we're offsetting. The other thing that's real important is we have the matching rule of active income can be offset by active deductions. Passive income is offset by passive deductions. So you mentioned our owners that are absentee owners, but they may lease the land out, whether they could operate it and have their own ranch manager on site, and they would be actively involved with that, right? Or they may have a lease agreement where they lease it to a neighbor or somebody that runs cattle all over or farms, in the area. And so we need to make sure that their lease agreements match up to offset the correct type of income on active and passive. And we have some attorneys that we've worked with, and they've educated us and we've educated them. And of course, we learn from every client we have a discussion with, so we can make sure that the right language is in those lease agreements or amend them going forward or whatever we need to do. So that's the process as we do this kind of desk evaluation of this is what we can expect based on the data in your area. We've worked in all 50 states now, and certainly throughout Texas, where you and I spend most of our time, we have some really good data, and this is our fastest growing state for doing more and more deductions. So good data in every region. We can get that number in place. We'll be able to see what our cost basis is if we have any limitation there, and then your number of acres And what I usually do is build a map and make sure that we net out any acreage that either has a large water feature. We may have a 25-acre lake. We may have improvements. We may have roads and oil and gas pads. And so we'll just net that stuff out. You don't want to pay for those acres, and you can't deduct those acres. So I pretty much say if a plow's going over it, or if we're growing grass and it's inside the fences where the cattle can graze, then that acreage is what we need to count.
Yeah, got it. Taylor may have to cut a little pause here so I get my question.
Well, back to the rest of the process. Okay, disc valuation. Now you make a decision as a landowner or with your tax professional. Oftentimes, this is when we have a call with the CPA. So there is quite a bit of work to be done, Kasey, before we ever get to entering the information and sending off what we call a request for service. But we do have a portal where we'll enter all of that information. We can actually enter up to 10 different pastures or fields in each agreement there, the request for service per entity. So we have several landowners that own in different entities, right? Some in their personal name, some in an LLC here, some with a brother and sister or another set of partners. So each entity will have to do a different request for service form.
Okay.
We'll enter all that information in. It'll automatically generate a DocuSign contract, and then whoever is the authorized signature on that signs the contract. At the time that they do, Belisafra will collect $12 per acre, or about a third of the price. When we got close to the end, we had a lot of people that they have an option to pay the $40 an acre up front so that they can have the entire expense within a tax year.
Yeah.
But they'll at least do $12 an acre, and that basically covers the cost of sending the field crews out.
Got it.
Field crews will show up. Well, they'll call you at least 24 to 48 hours in advance. They'll come with ATVs. And so we need to be aware of, if it's on cropland, then we need to be aware of what their planting season and harvest season is. Make sure we're not in there when it's too tall and we're running in that. We won't do any we won't do any work that's going to disrupt the farming productivity, right?
Yep.
Rangeland we can do, like right now, most people are planting, so we're doing a lot of pasture land right now. The soil samples will go back to the lab. They'll run all the agronomic analysis that overlays them with the economic analysis on that. And then we start a process of this is where we kind of go into the different tax codes, right? Yeah. The fun part is when you can educate our land buyers on using this programmatically as they purchase a new piece of dirt, then they can use what is Section 180. It's the most stringent on the requirements, but it also allows you to accelerate that depletion and take that deduction in the year that you purchase or inherit. So it's a conversation that we need to be having with our buyers. And then if they programmatically start looking at this, they start with a different set of lenses evaluating every purchase opportunity.
So there's a difference in the Section 180 and the legacy nutrient deduction.
Well, the Section 180 applies.
They're 2 and 1, but there's not always, right?
But it's only applicable if you use it in the tax year that you purchased or inherited.
Okay.
Then you can accelerate. Okay. If you purchase land last year or before, then you cannot use Section 180. Actually, you could for like 2025 if you haven't paid your taxes yet. and we can roll that in by October. Yes. And then you can still use that, the Section 180, if it's going on the tax return for the year that you purchase or inherit. If you purchased land in the past, it depends on when that was. If it was within the last 3 years, then you're still going to use, again, according to your accountant. But what we've seen them use is Section 167, Section 168, which is your general depreciation codes, and then 611 is more related to minerals, but a lot of our oil and gas guys like to use that because that's how they already classify the land in that category.
Got it. I didn't know there were several sections.
Yes, sir. There's actually 4 different sections.
Dealt with the legacy nutrient deduction. Okay.
4 different tax codes and 3 different ways to use it. So 1 is the 180, use it in the year you purchase or inherit. 2, if it's been in the last 3 years, you can amend those tax returns The warning there is, and again, according to your tax professional, get their advice, that can restart the clock, or it does restart the clock for audit if you amend those.
And what section is that you can do that?
Well, that's usually 167 and 168, or it could be 611.
Okay.
And if it's been prior to 3 years, then we have to use a form 3115, which is a change of accounting practices that's going to affect years 4 to 20 years ago, right? And then you would go through an amortization schedule too. So most of the more risk averse tax professionals will advise to go a 7-year straight line schedule, amortization schedule on this depletion. More aggressive might go on a 3-year schedule. So then depending on when you bought it, if you bought it 10 years ago, you could have taken all of it. And so you may still take the entire deduction this year.
Yeah.
So we just need to go through all those situations. Again, this is all part of that desk valuation to make sure that we've got a good picture of how to use this before you go through the whole process and what the expectation is.
We bought our place here in Erath County, I think in 2021. Built our house in 2022. So that would put us in the form 3115.
Yes, sir.
Okay.
Yes, sir.
Got it. We're going to do this on our place.
Good.
You've probably got 36 acres on our home place that you could apply this to. I think once you took out everything else, maybe a little less than that when you took the lake out. 35 acres. Yep. Well, gosh, I didn't realize there were several sections, Kyla.
Yes, sir. It really opens up to a lot of different opportunities for people. And so when they go do the soil samples, then the team will reach out to them and ask them if they've got any fertilization reports, animal unit, head counts of what they've run, if it's on the cattle side or on the livestock side. And then if you're a farmer, we've got all your fertilization schedules and yield reports. So they'll use that then on the economic evaluation as they create this report. So when the report's done, and that whole process takes about 60 days, start to finish, then you'll get a final invoice that will pay the remaining balance of that $28 per acre.
Yeah.
And then the report's released to you, and certainly we can copy your accountant if you'd like to do that. And then you just go into a consulting phase of, the company has, not only do we have CPAs that are consultants for our company directly, but also the leadership staff is available to help coach CPAs through, okay, now where do I actually put this on the tax return and how much do we need now? Yeah. Another real flexible thing, Kasey, that I've loved is there's no requirement to even use the deduction once you go through the process. And there's no requirement to use it now. It's always going to go back to the date that you purchased the land.
Okay.
So you can have a number to sit here when you might be needing to offset income that you expect to come in the next couple of years. For instance, we've got some West Texas ranchers that are going through the evaluation process right now, because they have considerable pipeline deals coming through them. And they've been accelerating. They were over 5 years, then they were over 3 years, now they're over 2 years. And so they've got some income to offset. We've got farmers and ranchers looking at solar income, wind income, and as they evaluate those leases, and they may be 2 years out from construction, and they're getting some income right now, but then the big income comes in 2 years. So now they have a deduction that they could use at that time. So a lot of strategy and flexibility, again, in the more complex we get, and the higher wealth individuals that we have ranchers that have never had this kind of income either. And so they've always just broke even as operators and not really had a bunch that they needed to offset. But we've got guys in the cattle business that are making more than they ever have. We've got these new ways to make money on the same land or in their businesses.
Yeah. Am I required to keep the land in production after this?
No, there are no requirements There's nothing filed of record. It is not like a tax. It's not like a conservation easement. In fact, that was another question: is people ask, can we do this on land that has a conservation easement on it? And that depends.
Yeah.
If it allows you to still operate in the agricultural space, yes.
Yes.
So, and it's endless the opportunities that we keep finding as we have more and more conversations with people.
And the reason I'm not required to keep it in production, I'm thinking, is because as a buyer, I purchased the land, including the excessive legacy nutrients.
Mm-hmm.
So I can go recapture that. I can go depreciate that and still change the use and go into development because I bought the nutrient, whether I'm going to use it or not, I bought it, right?
Yes. So if you were using it in agricultural production, then up until now, we're very careful on what that situation is. You know, if you're not actively pursuing development on it right now,
Yep.
then you're probably okay. If that opportunity comes up in 2 years and then you shift, but you took it now, that's fine. That's now a new highest and best use of that land. So again, those conversations we need to probably talk through and make sure everybody's aware of any consequences.
Sure.
So the one thing is it is true to depreciation. So you've either got recapture at sale, and again, your more conservative accountants have advised their clients that this would be ordinary recapture. The more risk tolerant would be that this is long-term capital gains, depending on when you sell it, right? So oftentimes people go, well, what am I going to do at that time? What if I sell it? Well, it depends. Are you going to do a Section 1031 deferred exchange? And if so, we have investment strategists now that are actually buying a piece of ground, taking the depreciation, 1031ing that into another piece of ground, taking the depreciation.
The depreciation. Yeah.
Yes. And then they just take that down where it had a conversation with a gentleman the other day that bought at $8,000 an acre. He got a $2,000 deduction, so it depreciated the basis value. And so he 1031'd into another piece of ground, took another $2,000 deduction. 1031'd into another piece of ground, took another $2,000 deduction. So now he's only got $2,000 left. And now he's buying something that he wants to hold forever that's adjacent to his current operations.
Got it.
The other thing they can do is just continue to purchase and sell, purchase, sell, and do that 1031 exchange. And if they don't have another fee simple piece of property, but they want to keep that, defer the taxes again, another strategy we can use is to put that into a DST, into a Delaware statutory trust. Now that money is in there in a commercial income producing portfolio that will also get a step up in basis at their passing, depending on how their generational transitions planning.
So the money I get from this, I can exchange with that money because it's considered real property. I did not know that.
Yes, sir.
Did not know that.
So a lot of great strategies here that we keep learning.
High level tax stuff.
Yes, sir.
To learn. Not that you're advising on us.
Not advising.
Why have we not heard about this? Because most CPAs are compliance CPAs. They're not tax strategists. Or why is this? Why don't you hear about this more often?
Yeah, that's a great question. We hear this all the time. One, is it too good to be true? Why don't I know anything about it? And just like the guys that started this company, they didn't know either. Just happened to have a new CPA that had learned something and brought it to their attention. And their old CPA said it wasn't structured enough. I didn't want you to take the risk. And so now if you put together a program that is structured well enough and you can back it up where I'm not going to be in trouble if this goes to audit or have a high confidence level, then let's look at using this. The biggest thing is only 2% of the United States citizens that pay taxes have anything to do with agriculture. So the tax professionals that serve that niche they're very few. And I don't know if you can call your CPA lately, but mine's one of my very best friends, and I can get a better response about a birthday party than I can about my taxes because they're so overworked.
Yeah.
And the tax code's 7 times as big as the Bible, and it changes every year. So I think it's one of those, we spend most of our time, probably 80% of our time, educating tax professionals and not only on what this is, how we're using it, what we've found, after 7,000 cases, whether it's webinars, one-on-one calls, and usually it's with an entire firm, is we'll just set up a Zoom with an entire firm and go through with all of their CPAs, and it's usually a wow, and they're making lists of all their clients that could take advantage of that. So once we get through the education and then the confidence level with these tax professionals, most of them are on board. Some of them are not willing to learn anything new, or they're not willing to take a risk on changing anything on the way we've already done it. Always done it for this tax, for the taxpayer. We're not going to. We don't want to change. We don't want to cause any attention here. And so it does become a strategy and a risk profile. Yes, sir.
Yeah.
This episode is brought to you by the Mock Ranches Real Estate Group. At Mock Ranches, we specialize in representing buyers and sellers of farms, ranches, and recreational land across the state of Texas. Our team sold over $1.25 billion of Texas land, and we focus on helping landowners make smart decisions about their most valuable assets. If you're thinking about buying or selling, or simply want to understand the land markets better, get a hold of us at mockranches.com. Mock Ranches, Texas land represented right.
So, Kyla, is this something that we use, like working with buyers, we can use in our feasibility period? Is it something that can be underwritten or partially underwritten before closing? How would we use that in a strategy?
Oh, great question. One thing I do want to point out is this deduction is available one time per property per owner.
Okay.
So even if the deduction was taken by your seller right now or the current owner, when your new buyer takes possession of that property, they can also take the deduction.
Okay, that's another question I had. Does this, essentially from the IRS's base, does this devalue the property and the deduction is no longer available to that property, kind of like a conservation easement or something, but that's not the case?
Nope. It's going to be available one time per property per owner.
Per owner.
So every time it changes ownership, then it has another availability. And on your...
It's the same level, same valuation?
It won't be the same valuation because it's going to be dated at a different time.
Okay.
Right? So if you bought something and you're talking about your place in 21 and you sell it and the new buyer buys it in 2028, we've got 7 years of your stewardship to be reflected then on when they take title. So it's not really perpetual, but it would be your perpetual stewardship will get measured at the next time of sale.
How much does ongoing fertilization impact this? I fertilize my place. We've got native pasture, gets grazed. We don't farm it, so it's never cultivated, but it is grazed, and we fertilize it every year. We weed spray every year. I've not seen a native grass stand as healthy as what ours has in a long time. So how much does an ongoing fertilization program impact this? Yeah,
so good. You would be rewarded is the expectation, right? Especially if you don't overgraze it and deplete. As long as you're not depleting all those nutrients, if you're putting in more than you're taking out, you're creating a new excess.
Okay.
You'd always like to hit that right on the money, right? You only put on enough fertilizer to get exactly the grass to sustain however many head you're running on your place, or you only want to put enough fertilizer to raise this crop yield, but every year is different, right? So that's the way to measure then, right? Is you're expecting to put on more and not less, and if you're still a good steward of the land, then you would be rewarded for it, not only in the price of your land, but then the new buyer is going to have additional excess to be able to take the deduction for.
Typically, you're bringing in outside fertilizer onto fields, whether that's aerial sprayed or with a spray rig, granular or liquid, and organic fertilizer on pastures, being cattle, unless somebody is fertilizing their pastures.
True.
My father-in-law, he's been in agriculture his whole life. Last time I was at the ranch, he made a funny about a guy that was looking at a ranch that he has leased. He's got cows on this place. And he said this guy came in and he was talking all about the fields, and I love the fields. And my father-in-law was thinking, well, the wheat fields and the hay fields. Well, he was talking about the pasture. And my father-in-law,
There's a difference.
Was laughing. He was like, well, You can tell when somebody doesn't know what they're talking about if they don't know the difference between a pasture and a field. I thought that was funny because he doesn't make many jokes, but he made that one. Thought it's pretty good.
That's an old rancher's perspective for sure.
Yeah.
Yeah.
So how long would I need to go, Kyla? Like if I've got a buyer that's looking at a piece of property, but they want the whole pro forma, right? They want me to give them cost of management, what a projection is going to be on an exit in 3 to 5 or 10 years, cost of management, cost of improvements, and then what else we can do, depreciation, including soil nutrient.
Sure.
How long would I need for a feasibility period to work through and get an idea on this with them?
I think we would go back to our data that, again, we have really good samples in most every region, certainly in Texas, but in any of our surrounding states that are heavily ag or running cattle, we have a really good sampling every region. So we would look at what those averages are, and then we can also kind of do what's our current price of fertilizer. So if we're in a year, actually in 25, fertilizer went down from 23, 24. We kind of had this big uptick.
Well, we made it up here recently.
Yeah. So now if fertilizer still goes up, then we're now making an assumption that those deductions may be higher, right? So we can use some of that analysis there. And it even helps us on that negotiating factor too, Kasey, when we've got a buyer and a seller that are, maybe they're $500 an acre apart. And then we show this to our buyer and go, let's get a deal done here because look, you might have $2,000 an acre in tax deductions that we now can apply to your pro forma. So
to the right buyer, that matters.
To the right buyer, that matters.
Doesn't matter to everybody, but to the right buyer, that matters. Yeah,
it does. If they've got more income to offset and they're looking for deductions, and we know what that what that person looks like, and that's oftentimes the ones that are paying cash for a deal too.
Yeah, I was going to say that. Typically, our bigger deals today are cash. Bigger the deal, the more cash there is available.
Right.
Yeah, and there's more competition for the bigger ones also.
Right.
Closer it is to a consumer, harder it is to transact today, more debts involved.
Truly strengthens their balance sheet, though, because lowers their cost basis on their books, and they've still got market value on their equity side. So it's a strong play financially.
Where do you see people get in trouble here? What are some IRS guardrails?
The biggest one is just making sure that the land has been in agricultural production, especially if we're going back, right? I've had this conversation with several new buyers in the last, I don't know, every day, I think, or at least every week of, hey, oftentimes we are doing this prior to closing. So had a call with a client and his CPA that was closing on 3,000 acres last week. And broker called me today and said he got it done. He's ready to do your deal. But we went and forecasted what that would be, already built his maps, netted out whatever acreage we needed to net out. So he knows exactly when we can just press go now. I just talked to him on the way here. And does he have cattle to put on it today? He's got to go find them. And you know what they cost today, right? So the ranch has been in ag production, but those cattle are being shipped. And now he's got to go get cattle to buy on there. But that's in his plan. He may have to do some more fencing. So again, if you can tell the story to the IRS auditor that the intention was this was bought to be a cattle ranch, we've still got to go buy them. We've got to do, so today there may
fences,
not be cattle
water
on
development,
it.
et cetera. Yeah.
But we're really measuring what the excess value was from the seller and how was he a good steward of the land, right, on day one. And then only if we're having to hindcast do we have to look at what you put in, what you took off, now to balance that out to do the forensic accounting part when we have to go back.
Have you seen examples of people trying to do this on their own?
Yes, and sometimes they're trying to piggyback on some of your other programs and use the same soil samples, but very different. And some of them are intended to be wet soil samples versus we actually don't even take dirt out of the ground. We use a spectrometer that measures the light reflectivity of each one of those nutrients that we're measuring. So it's a different process, but some people are trying to do that. And there are a lot of we're not the only company. We're kind of the 800-pound gorilla in the room in this space. And our goal is that in the next 5 to 10 years, this becomes industry standard. And it becomes something that we're evaluating on every purchase. And it becomes something that's part of our generational planning as well. We've got 76% of our landowners in Texas are over 70 years old. So we've got a lot of opportunity now to be good stewards of their legacy, and whether they plan to sell, whether they plan to, if they've got a next generation to now set up the right entity to pass this on to, and to make sure that that has the ability to take a step up in basis so that the next generation can also utilize a tool like this.
Yeah. Yeah, it makes sense to me. If someone's listening today, Kyla, and they think they might qualify or be interested, what should they be thinking about? What should they do next?
I'd say call me.
Okay.
Call you, and then we'll get on the phone with them together. And it does take a conversation to understand what the situation is. Again, we need to look at, when did you buy it? What did you pay for it?
Yeah.
And what's your tax situation now? And not only now, but is there something that you're expecting that you need, a windfall of income coming in sometime in the next couple of years that you need to have a deduction ready to offset?
How early do you involve their CPA?
As early as possible.
Yeah. The CPAs don't like to be surprised with stuff later.
No.
We've been through several. We've got a really good one now. They're in North Texas, and I really like them. But we went through 3 CPAs in 3 years. But in that, the amount of money that we saved in income taxes was unbelievable, because we had a CPA that was not interested in learning. They weren't interested in getting in learning the code and really looking at what we do for a living and what all. They weren't interested in strategy. They just wanted an easy return. They're the 1-800-taxreturn.com people. There's a million of them. And so we went through several, and we finally found one that communicates well, that will entertain when I have a meeting like this, or read a book, or listen to a podcast, and I'll send it to them and say, are we doing this on our tax return? They'll entertain that and say, no, we're not, but we could be. Here's what you would need to be doing that. Or we're not for this reason, or yes, we are. Hopefully they say, yes, we are. And so, but they don't want to be surprised. Most of them I've learned don't want to be surprised by stuff that you've done already, and then you lay this in their lap, and now they've got to defend it, and they didn't have any knowledge of it.
I agree. We generally start with that landowner conversation, and if they are interested enough, and oftentimes it's like, well, I didn't know anything about this. And when they go, why hasn't my CPA told me? They probably don't know. Let's don't be mad at them.
Yeah.
Let's don't be mad. But let me gather some information, and that way, when we go talk to your CPA, or you can call them right now, merge them in. We've done that too.
Yeah.
But when we have that opportunity, then we can use some better examples of what that looks like for that landowner and explain to the CPA with a real case study in front of them.
Can you take this deduction over time? Like if you have somebody that's got, let's say it's a traditional farmer. I can think of a bunch of them. Traditional farmers, mostly Schedule F, they don't have excessive income, and they got a lot of deductions. Currently, can you take this over time where they could utilize it also, or is it somebody that needs the income all in 1 year?
No, it could be taken over time, and especially if it's on ground that you've purchased in the past, then we need to look at what that amortization schedule is. Again, you have the ability to accelerate, but what a lot of our operational farmers and ranchers are very comfortable doing is every November and December, after they have we're now through Q3 into Q4, how much money do I need to spend? And they're going to buy tractors and trucks and trailers, and they're prepaying, feed and fertilizer and seed and whatever they might need in the years that they're making money. Maybe they can't in other years, but then they buy all those tractors, trucks, and trailers, use Section 179, and depreciate those back to zero. So they're really not building their balance sheet, where when we put this tool in their hand, and at the end of, when they're in Q4 tax planning, they can go buy another piece of dirt.
Yeah.
And they can truly build their balance sheet by investing in more land. And oftentimes will shift their mindset from, instead of leasing land everywhere, this gives me an opportunity to buy it. Now I get the tax deduction with it. My cost basis is less, and we're building their balance sheet.
Got it. It's good stuff. I think agents, brokers, buyers, and sellers, and CPAs need to know all these things, because land is it's a big responsibility. It's a great blessing if you can hold on to it a long time. This is one that helps us do that.
Yes, sir.
Yeah, helps us do that. Helps us offset some of it. Maybe buy some more.
I agree.
So I appreciate you, Kyla.
Well, thank you.
How can people get a hold of you?
830-591-9840 all day long. So
boasafferag.com.
I actually have a link that goes straight to me that
We'll put that in the notes.
Okay, I can do that, and a QR code that's got some more information too for a quick link, because all of us don't even like to type a phone number anymore. We'll just send the QR code, but we'll start there, and then we'll work together on gathering the information, and let's talk through it and see what the opportunity is.
Outstanding, love it. Thanks.
Thank you, Kasey.
Bye, everybody. Get smart about taxes. The more you know, the less you have to pay.
Yes.
That wraps us up. I appreciate you listening to the Landowner Insider. If you found this episode helpful, be sure to follow the show, leave us a review, and share it with another Texas landowner. For more insights, listings, and resources for Texas landowners, visit mockranches.com. Till next time, I'm Kasey Mock, your host. This has been the Landowner Insider. Go get 'em.